Hello and welcome back to our final demo video dealing with Chapter 12. Chapter 12, again, we talked about the statement of cash flow. So in this video, we're going to work on problem 12-5B. This will help you out with your homework problem 12-5A. Okay? So what we have here is they give us free cash flow. They give us our operating cash flow to current liabilities ratio, and it gives us an amount. And then they give us the cash flow of operation to capital expenditure ratios. Okay? And they give us 6 transactions, and they want us to determine if each of these within each of these transactions, what kind of impact will it have on free cash flow, operating cash flow to current liability ratio, and operating cash flow to capital expenditures. Okay? So what we need to think about is how each of these transactions really impact cash, and how do we calculate free cash flow? How do we calculate the two cash flow or operating cash flows to CL and to capital expenditure ratios? Does any of these transactions impact any of that? Okay? So the first one says record credit sale $15,000. Well, if we just record a credit sale, that's all they're telling us. We just record a credit sale, right? So is this going to have any effect on free cash flow, operating cash flow to current liabilities, or operating cash flow to capital expenditures? No. It's not going to have any effect on either of these three. So I'm just going to say N, N, and N. Okay? The next one we need to look at is collected cash on account. Specifically, the book says collected $6,000 owed from customers. So this means that our account receivable is going down. We are decreasing our accounts receivable. Okay? Will that have an impact on free cash flow? Well, yeah, it will, right? Because think about it. If we increase a receivable, scratch that. We're decreasing a receivable, right? A current asset is going down. That means that we need to add that back to our, or add that into cash provided by operating activity. So that would actually increase free cash flow. Since it's going to increase free cash flow, it's also going to increase the other two. Here's why. How do we calculate the operating cash flow to CL ratio? Well, because our accounts receivable goes down, that means we add that increases our operating cash flow, right? We have a higher operating cash flow divided by the CL. In essence, that should increase it, okay? Same thing goes along with the operating cash flow and capital expenditures, right? We're increasing our operating cash flow. We're increasing the top number. So that should have an increase in the operating cash flow to capital expenditures ratio, okay? The next one says that we purchased $45,000 of equipment using long-term debt, okay? So this is an example of a non-cash investing activity, right? It doesn't affect anything, right? We just note it. We don't add or subtract anything when we're doing the statement of cash flows. We're just noting it. So we have no effects here, okay? Now the next one says purchased $70,000 of equipment on cash. Okay, so let's think about this now. We're using cash to buy equipment, right? That's going to affect free cash flow because think about how we calculate free cash flow. OCF, or cash flow provided by operations, minus our capital expenditures or our investments cash flow from investing activity. Okay, so this will actually decrease our free cash flow because we're using equipment. Equipment has nothing to do with current liabilities, right? Doesn't have anything to do with current assets either. So this is a no effect. It does, however, impact the operating cash flow to capital expenditure ratio, right? We're increasing our capital expenditures. We're increasing the bottom amount, or the denominator. So in essence, that one should also decrease as well. Okay. Paid $17,000 of wages using cash. Well, yeah, this is going to affect free cash flow. It definitely is, right? Because that's part of operations or cash flow from operations activity. So that's going to decrease it as well. Okay. It's also going to decrease operating cash flow to CL ratio and operating cash flow to capital expenditures. Why? Well, because think about it. What are we doing here? We're using cash to pay wages, right? That means we're decreasing our numerator in both of those two ratios, okay? And then finally, the last one says record utility bill that has not been paid yet, okay? So let's think about this. Well, it's a utility bill, really hasn't been paid yet, so it's not really going to have an effect on our free cash flow. So no effect. It will, however, have an impact on the operating cash flow and CL ratio. Why? Because we have a accounts payable here. Accounts payable is part of the CL ratio, right? So we're actually increasing that current liability, which should decrease our ratio. And this has no impact on operating cash flow to capital expenditures because current liabilities are not in the numerator or the denominator here. Okay? So hopefully that made sense for you. If you have any questions, please let me know. I'd be happy to discuss them with you. So now you're good to go and complete the homework problems for Chapter 12. So we'll see you back here when we cover Chapter 13, which deals with analytics. So thanks and have a great night.